Yesterday, you had a video that explained the detail of a typical payroll entry. On your screen, you see another one. This one is for the Excel Cleaning Services Incorporated. And we've had this company before, but now the salary expense, the payroll is handled a little bit more in detail than it was in a previous problem. Let's take a look at this before. I want to show you how this is posted, which is very simple. It's a process that you should be familiar with already, but there are a couple new wrinkles with this that I want to explain. So let's go through a couple things. First of all, we will assume that for the Excel Cleaning Services Incorporated, the payroll is done on a monthly basis. So this date, we're looking into the future now. This is the end of March 2019. So every month, this entry that you see here would be done by the bookkeeper or the accountant for this company. So at the end of January, you would have one that would be very similar to this. At the end of February, and now we are in March. The reason I mentioned that is because when we look at the ledger, and we'll look at the tabs down below as we usually do, and we see that we have, first of all, the assets, and the only one I have here is cash. There would be obviously a number of entries from the previous months in these accounts in the ledger, but we're going to show you only what is relevant to this particular problem. So if you look at cash, at the end of February, that would be the previous month here, we had a debit balance of $45,678. The other thing I want to show you in these accounts is that these particular accounts have a balance line at the bottom of each account. So this is a formula whereby if you put a number on either side, for example, let's put $200 credit, you'll see that the balance has adjusted. And it went down because if you credit cash, it should go down. So each of these accounts will have a balance at the bottom, and we'll use that in a few minutes in our explanation. So the only one relevant in assets for us right now is the cash account. Let's look at liabilities. This will be a bit different. First of all, you have an accounts payable at the end of February. We owe $7,842. It's a liability. We owe it. That's the balance. But we have three new liability accounts in this particular business that we had not had in previous topics. Account number 202 is federal income tax payable. That's the number 202 for this business. Now I want to show you what's in this already. At the end of January, as I said, we had a payroll. We had that payroll entry. And if it had been journalized and then posted, we would see something like this. The date, January 31. The reference would be journal page 13. And then we would have had a credit, which means as part of the payroll entry, federal income tax payable was credited by $6,000, which means out of the money that the employees earned, we withheld $6,000. Later, we will pay it to the federal government. But typically, it's due at the end of the quarter, which means at the end of 3 months. So back in January, we recorded the $6,000, but didn't pay it. It wasn't due yet. At the end of February, the same thing happened. Again, we had a payroll entry at the end of February of 2019. And this happened to be, for sake of this problem, this came from journal page 14. And again, the same amount was credited again. We withheld that much money from the employees. They earned it. We, by law, have to withhold it from their paychecks. Eventually, we will have to pay it for them. It's really their money, but it's considered a liability right now because we withheld it from their paycheck, and we will have to pay it. And now you see that the balance down here is $12,000. That tells me, obviously, if this were the end of the quarter, that's how much we would have to pay on behalf of the employees to the federal government. So the same thing happens with, in this case, Ohio income tax payable. We withhold at the end of January of 2019. In this case, $4,500 is credited. It's a liability account. Same thing happened at the end of February, same credit, and the balance is shown at the bottom of this particular account as well. And finally, the third one, FICA tax payable. As you know, that encompasses Social Security deductions and Medicare deductions from the employees. At the end of each month, we have a credit, in this case $2,000, and a balance at the bottom of $4,000. So in all of these, we have incurred some liabilities because we kept the money from the employees by law, and we will have to pay it. We don't have a city income tax here in this particular problem. So those are the liabilities. Stockholders' equity, that's the value of the business. That won't concern us in this particular problem. And if you remember, in revenue and in expenses, for some reason that we haven't really explained to you yet, these accounts at the end of each month end up with a zero balance. So we are just showing them as empty accounts at this point in time. We will be using this account, salaries expense, and that as any expense is not showing a balance at this time, but we will be using it in this particular entry. So let's go back to the journal and let's do the posting. So first line says salary expense of $24,000 that's debited. So we would go to that account, and this is at the end of March of 19, and this is journal page 15, and it's a debit of $24,000. Somehow at the end of this month, there are further entries that will reduce this account back to zero, and that's much more complicated than we need to get into at this point. But the journalizing and the posting needs to be done, and that's what we've done here with a debit to salaries expense. The account is 504, and we go back to the journal and finish the posting of 504. Federal income tax payable, $6,000. So we go to the liability accounts now, and we find federal income tax payable at the end of the month. Whoops, I did that wrong. March 31 of 19. This is journal page 15, and it was a credit of $6,000. So you now see what happens with the balance down here of $18,000. We'll come back to that. And to finish our posting, we take the account number, which is 202, back to the journal. Do the same thing with the Ohio income tax payable. Again, journal page 15, and it's the same amount. Now, these amounts could vary depending on a number of things with the business, employees coming and going, that sort of thing. But we'll make it simple here and keep the numbers the same. This account should have a number. And let's put these in. That should be account 203. This should be account 204. And now we put the money into Ohio income tax payable, and let's take the account number back to the journal. And finally, the FICA tax payable. Same procedure. Posting is no different than it was before. $2,000, and the account number 204, back to the journal 204. And remember, as we said yesterday, when we do these salaries expenses, cash will be, in this case, $11,500, but in effect, you need to calculate it by subtracting these three numbers from the $24,000. You subtract what we have withheld from the employees to get their net pay. So now we do use cash, and we go to the cash account. And this is J15. And and we credit because we spent cash. Okay, and you can see what happened to the balance here. It went down. Before we put that money in, we had a balance of $45,678, and a credit reduces cash, and that's a balance now of $34,178 is what we have remaining. And the account number, back into the journal. So posting is as simple as it was in the previous topic. That process is the same, but what I want to point out to you is what's happening in these liability accounts. Again, this company pays on a monthly basis. So every month we have this same entry. And the federal government and the state government as well typically requires businesses to pay these liabilities at the end of the quarter, so at the end of 3 months. So what would happen then is if we get the bill from the federal government saying, okay, company, now you need to pay us what you owe us. And we know how much that is because we go to the account, federal income tax payable, and we have a balance of $18,000. So if we were to pay that at this point, if it's March 31st, 2019, and we're going to pay the amount that we owe, again, this was what we withheld from the employees, but we have to pay it on their behalf. So we need a debit in the journal to federal income tax payable, and we need a credit to cash. So if we were to do that, and we debit in the journal, and we end up posting $18,000 to federal income tax payable, you see what happens to the balance. It goes down to zero. So that we'll be talking about in another day or so in a little bit more detail, but that's how this typically works. Same way with Ohio. If we get a bill from Ohio regarding payment of income tax for the employees, we are going to need to pay not one of these, but the total amount that we owe, which is in this case $13,500. And that again is a debit to a liability account, in this case Ohio income tax payable, and a credit to cash. So we're going to come back to that. There's a little wrinkle with FICA that we will need to talk about later as well, but we'll leave that for now. But this is the process. You'll have an assignment or two where you need to take a payroll entry similar to this one and post it to the ledger. So not a difficult thing, but it's important that you understand the process, and particularly the fact that these are unique kinds of liabilities, as I mentioned earlier. Most liabilities exist because you owe money as a result of gaining an asset. These are the exceptions to that rule. We don't really gain an asset here, but the generally accepted accounting principles tell us that these are still considered liabilities. We owe the money, and eventually, as I mentioned, we have to pay them. So at this point, there are a couple questions I want you to answer, so go back to your course page.